Hello. We'll now review the homework problems that were assigned for Chapter 11. We're going to go through problem 11-1, 2, 7, and 11. 11-1 asks us about the initial investment outlay. This company, Talbot Industries, is considering launching a new product. The new manufacturing equipment will cost $17 million. The production and sales will require an additional $5 million in investments in net operating working capital. The company's tax rate is 40%. What is the initial investment outlay? Well, first we're going to look at the equipment, since we know that we're going to be buying new equipment. That'll be $17 million. And then the problem also tells us that we're going to require an initial $5 million investment in net operating working capital. That's going to be an expenditure of cash. So our initial investment outlay is $22 million. That's our initial cash outflow for year 0. The company spent and expensed $150,000 on research related to the new product last year. Would this change your answer and explain? Basically, this is asking us if that $150,000 should be considered an initial investment outlay. Due to the fact that this occurred last year and was not related to the decision of whether or not to launch the product, we would consider this a sunk cost. It does not represent an incremental cash flow, therefore it should not be included in the analysis. We spent that money regardless of whether or not we decided to launch the new product. Therefore, it doesn't factor and is not relevant in the initial cash outflow. And Part C asks us, rather than build a new manufacturing facility, the company plans to install the equipment in a building it owns but is not now using. The building will be sold for $1.5 million after taxes and real estate commissions. How would this affect your answer? This building and the potential sale of the building represents an opportunity cost of conducting the project in that building. It would be considered in our analysis, and the possible after-tax sales price must be charged against the project as a cost. It is a cost of doing the project because had we not done the project, we would be able to sell the building for $1.5 million after tax. It is relevant to our decision and should be included as a consideration. Problem 11-2, operating cash flow. The finance staff of Karn Communications has identified the following information for the first year of the rollout of its new proposed service. Projected sales, $18 million, operating costs $9 million, depreciation $4 million, and interest expense $3 million. The company faces a 40% tax rate. What is the project's operating cash flow for the first year? So this is not asking us about year 0 or the initial cash outlay. It's asking us about our operating cash flow after we've launched the project for the first year. Let's look at the information given to us. So we know that sales revenue are $18 million. Operating costs are $9 million. Basically, I've built an income statement here. Depreciation is $4 million, and our operating income before taxes is $31 million. At a tax rate of 40%, our taxes are $12 million, and our operating income after taxes is the 31 minus the 12 for $19 million. You'll see here that I added a line that says add back depreciation. This is due to the fact that depreciation expense is a non-cash activity. It's an accounting entry, and no cash actually exchanges hands once we book this to the income statement. Therefore, in order to get to our operating cash flow, we'll need to adjust our operating income after taxes for the depreciation. So we'll add back our depreciation at $4 million to get operating cash flow. Excuse me. Oops, sorry. Let's see here. My formula here is not correct. We're going to take 18 million minus 9 minus 4. Sorry about that. So now we'll add back our depreciation of $4 million, and we have operating cash flow for year 1 of $7 million. Problem 11-7, looking at a new project analysis. You can read through the paragraph and understand that basically we're looking at acquiring a new piece of equipment for the firm's R&D department. The cost is $70,000, modification costs of $17,000 to modify it for special use by the firm. The depreciable life is 3 years, salvage value is $30,000. We're using the Mackers rate, which has year 1 0.333, year 2 0.445, and year 3 0.1481. You can see that off to the side. So I entered all of this information as what do we know. So you can see that here I've added up the total depreciation rate for the 3 years. That means at the end of the year, our salvage rate is going to be worth 0.0741. Our cost savings pre-tax is $25,000 per year, and our marginal tax rate is 40%. So part A is asking, what is the year 0 net cash flow? So that means what is our initial cash outlay for the year. So first, we're going to consider that we have to pay $70,000 for new equipment. That's an outflow, so I'm putting a negative there. We're going to have modifications, which is an additional outflow of $15,000. And then our increase in net working capital is going to be an outflow of $4,000. So year 0 cash flow is going to be an outflow of $89,000. Now let's look at what are the net operating cash flows in year 1, 2, and 3. We'll start with our after-tax savings. So going back to the original information that we were given, we know that our cost savings pre-tax is $25,000. Therefore, it would be the $25,000 times our marginal tax rate of $40,000. I'm sorry, 1 minus our marginal tax rate of 40%, which gives us $15,000 is our after-tax savings. So that's the same for each year. The problem doesn't tell us that this changes. And now we need to figure out our depreciation savings. In order to do that, we need to understand what our depreciation basis is and then multiply that by the allowance percentages for each year. So our depreciation basis is $85,000. Okay. And we also have a tax shield on that at 40%. So we would take our $85,000 times our year 1 rate times our 40%. That gives us 11,332, and then we'll do the same thing. Let me show you how I got the $85,000. It is our initial cost of the equipment plus the modification cost to bring that equipment to our special use. There's the $85,000. 85,000 again times our year 2 times our marginal tax rate and our year 3 rate times again our marginal tax rate. So year 1 is 26,332, year 2 is 30,113, and year 3 is 20,035. What is the additional year 3 cash flow, i.e. the after-tax salvage and the return of the working capital? This is known as our terminal cash flow. It's calculated by looking at our salvage value, the tax savings on our salvage value, and the return on working capital. So let's start with our salvage value. We were told it's 30%. Okay, and then we have our tax savings. We need to calculate how much is left on the books. So let's take a look. Our book value in year 4 is $85,000 times the remaining 0.0741. Remember, we calculated this up here, 1 minus the depreciation that we already took. So it's going to equal our 85,000 times our 0.0741. So now we can calculate our tax savings as our salvage value minus what we have on the books times our marginal tax rate for a total of 9481. Okay? And then we have a return on our net working capital. So remember, our net working capital was 4,000. That gives us a year 3 terminal cash flow of 24,519. And finally, if the project cost of capital is 10%, should the machine be purchased? Let's input our cash flows. Year 0, we'll remember, is 89,000. We put in year 1, 2, and then for year 3, we're actually going to take our year 3 net operating cash flow plus the year 3 terminal cash flow, which is 44,555. Then we use our net present value formula at a rate of 10%, our year 1 through 3 cash flows, and then add our initial cash outlay, giving us a net present value of negative 6,700. Would we accept this project? No, we would not accept it because it's less than 0 and will not add value to the firm. Finally, let's look at scenario analysis for problem 11-11. This company is considering a proposed project for its capital budget. The company estimates the project's net present value is $12 million. It assumes that it will be the economy and market conditions will be average over the next few years. However, the CFO forecasts there's only a 50% chance that the economy will be average and has provided us with this scenario analysis. So these are the economic scenarios, the probability of their income, and the net present value at each scenario for the economy. These are all given to us. What are the project's expected net present value, standard deviation, and coefficient of variation? So let's look at our expected net present value. In order to calculate this, first we would take each of our net present values times the probability of that income and add them all together. So again, we're taking each of our net present values at their expected probability and taking the sum of that. Oh, looks like I did something wrong there. Here we go. That should be a multiplication. So you can see it's very easy to mess something up. Another way that you could do this is by doing it for each one individually. And then taking the total of that. You'll see it's the same. And there is the formula for you if you need to see it. So now let's look at our standard deviation. Standard deviation is equal to the sum of probabilities times the net present value minus the expected net present value squared. Then we take the square root of that calculation. So said differently, this is what the formula would look like. Okay, we're going to have each probability calculate the probability of the outcome times the expected net present value minus the expected present value that we calculated here squared, and then take the square root of that. So let's do that over here, shall we? So the probability times NPV minus the expected NPV squared. And then we'll do that for each scenario. We'll sum them up. Whoops. And take the square root. So you could see that there's a couple of different ways to take the square root. I summed up those and then I used the square root formula, which is SQRT. Alternatively, you could sum those again and take it to the 0.5 power. It will give you the same answer. Okay? Oops, sorry about that. There you go. And now the coefficient of variation. The coefficient of variation is simply equal to the standard deviation divided by our expected net present value. If I could spell deviation correctly, that would help. So we would simply take our standard deviation that we calculated here divided by our expected net present value. Okay. So what does the coefficient of variation tells us? It tells us it measures the amount of risk per dollar of NPV. So the coefficient of variations can be helpful when comparing the risk of projects with different NPVs. It's hard to look at it on its own without understanding the benchmark that you want to compare it to. Hopefully this answers some of the questions that you had on Chapter 11. Thank you.